Hi, this is George Sandman. I'm the founder and CEO of Growth Drive. Growth Drive is the number one best-selling business advising platform, and this is our podcast, The Business Advisor Hot Seat. Now, in the hot seat, you're going to hear from industry leaders, thought leaders, your colleagues who are going to share tips, techniques, war stories about building a thriving advisory business based on delivering client wins. We're going to get into it. We'll get into it about the Growth Drive methodology, the Clarity software, what we see out in the world, so much more than just the system. And I'm also the author of The Growth Driving Advisor, which is based on over a decade of being an advisor to advisor, working with you and your colleagues, helping them build their practices, helping them through client engagements, and it's really proven strategies for leading businesses from stuck to best in class. Check it out. So strap in. We're going to light this up. Here we go. Well, welcome, ladies and gentlemen. And this week with me is a long-term colleague and friend, Bob Dunn. Bob is with GF Data, which is an ACG company. And Bob, rather than butcher the introduction, I'll turn it over and I'll let you introduce yourself.
Thanks so much, George, and thanks for having me on. I'm really looking forward to this. So it's Bob Dunn, Managing Director of GF Data. What is GF Data? We believe it's the best source of middle market private equity-backed valuations and other deal data that's currently out there. We have a sort of different sort of methodology. We get our information directly from more than 330 participating private equity firms in the middle market. We survey on more than 30 data points for every completed transaction they do. But unlike other data products out there on it, we're not telling you who did what deal, but we're trying to provide a benchmark for where valuations are based upon industry, NICS code, that sort of thing, and size of transaction. So all the data we take in, we aggregate, we anonymize the information, and then we provide it in mean, median, top quartile, and bottom quartile slices on our online database, which we relaunched last summer, and then also through a series of quarterly reports that we put out throughout the year. Business was started in 2006, and I've worked in a number of financial information products over the course of my career. All the good ones were coming from practitioners that were operating in a given marketplace, and they saw a need for information that wasn't there. And so in this case, the two co-founders, Andy Greenberg and Graham Fraser, on the sell side and buy side, investment banking wise, respectively, came together and said, it's really tough to get information on private companies, especially at the smaller end of the market. You don't have debt syndication that's out there. You don't have some of the other tools that you have for slightly larger transactions. So that's what they set out to solve. They had the network of private equity. I was thrilled to be brought on to operate the business when the Association for Corporate Growth acquired it in 2022. And it's a great place to be. And I love the middle market. Started my career as a journalist covering private equity back in the late 90s. And at that time, post savings and loan crisis, there wasn't anything but the middle market. So it's fun to have started there and kind of come back to where I began on this one. And middle market's a really great place, as you know.
Yeah, absolutely. And I've been working with you guys for a long time. I absolutely love the data, and I'll give a plug. I mean, the data that you guys generate is fantastic. We rely on it. We intend to expand our reliance on it. You have some new products that I'd love to maybe we'll turn this into a GF Data infomercial. But you have some new products
on the market
that I'm tremendously excited about. And what I really like is that it's private equity. So we at Growth Drive, we talk about the private capital markets perspective on value and what they value and why they value companies the way they do. And GF Data, I know that we have a very similar interest. And you and I tend to geek out on data in our conversations. But let's talk about the background, like the data you've been generating to date, right? What is the span of business sizes you typically work with?
Yeah, so we're focused right now on businesses with enterprise values between 10 million and 500 million. So definitely that lower half of the middle market, if you define it as sub-billion-dollar companies. Sure. One thing that we're launching shortly, which is interesting, and this has actually been driven by market activity, we've noticed a pronounced uptick in add-on investments. We track both platform investments by private equity, which for your listeners out there who aren't aware, that's kind of the base of a company, generally a larger acquisition. And then, what the sort of de facto model on it is you do a buy and build strategy. So you acquire smaller businesses around that and build that up over time. The number of add-ons that we've seen over the course of the last 4 quarters has been substantially higher than we've seen prior to that. Some of that's market related. We had challenged debt markets in 2020, latter part of 2023, and good chunk of 2024. It's easier to finance add-on investments generally because you often have an existing credit facility based on the platform or revolver of some sort. And then also, if you look at where a lot of these companies were bought, and we have this data, 2021, a lot of these deals were done there. There was an uptick in deal activity. That uptick also created an uptick in valuation on it. And if you compare, and it varies obviously by size and industry, but a lot of those companies are not at the valuation where they were in 2021 when a lot of them were purchased. And we're now in that window when private equity is looking to exit. So that build-up strategy there can help you drive up the value of the investment, get a little more critical mass, and get the valuation up from where it might be today versus when the initial investment was made. But in terms of the data set, we go back to 2003, more than 5,500 transactions tracked in the database. We broadly say we collect data from private equity. That includes funded sponsors, which are the majority of contributors that we have, but we also take data from family offices, independent sponsors, and also mezzanine funds as well. So those folks in kind of the middle of the capital stack as well. And they're interesting because they're obviously participating on a lot of deals. So that gives us a little bit broader exposure through those groups.
Yeah, and something you and I have talked about that I want to explore a little bit. When we talk a lot about during down, up markets. One of the things that our software tracks is, hey, if be planning on your exit time, and if you have not included considering the strength or weakness of the market, then you're making a giant mistake. Something you and I, what people don't get, they're always like, well, do you adjust your, talking about clarity, right? Do you adjust your values, your multiples based on, the market's down? So have you adjusted? And you and I talked about this, and it's fascinating. It really struck a chord. During a down market, there's a flight to quality. And multiples do get, and correct me if I'm wrong, I'm just remembering our conversation, multiples do get depressed. But there's so much capital out there that this is a hydraulic situation, so that actually the competition for those high quality deals squeezes the multiple back up. So we see a pretty stable, in general terms, pretty stable multiples, but the number of transactions in a down market gets compressed. Is that comment on that?
Yeah, I think you're exactly right. And the kind of hydraulic metaphor, I think, is completely right on it, right? You're going to see, in the market that we're in right now, and we just kind of crunched the second quarter numbers. We'll be publishing those reports and updating the database in the next couple of weeks. But we did see an increase in deal volume, a decrease in deal value. Now there's some sort of additional factors impacting that. I mean, tariffs being one of them, and I think you saw a lot of deals that would have closed in the first quarter being renegotiated based on what happened early in the second quarter and ultimately closing. And so we track that as a second quarter deal on it. Some of that brought multiples down, but then for those higher quality companies, if they are out there on it, that becomes even more desirable in that sort of environment, right? You're looking for the kind of gem in the midst of, challenging conditions. You're looking for a company that can, make that glide path about a 3-year investment cycle. So you're looking for a business that's very well operated, that understands the gravity of going through a sale, an owner who's focused upon the sale process, an owner who's focused upon who they're ultimately partnering with on the business, right? Because as you know, the completion of a deal with private equity generally isn't the end for the seller, right? There's going to be some rollover equity there. There's going to be some additional skin in the game. Private equity wants that to align interests and incentives, but you're not looking at it as hey, sale's done, sort of dust off the hands and gone. You're going to be partners for foreseeable future on it. And I think that's something that also both sides need to be looking at it kind of outside of the data on it. But I do agree with you, though, that in more challenging times, those top performing companies, if they are out there, are highly sought after, and they will always generate a very, very strong multiple.
100%. We talk about, again, in my world, I describe that as strategic capacity, and we say that play out in our own data. Businesses with high strategic capacity there's a lot of good that comes from having this very predictable, predictable and sustainable cash flow, a growing cash flow.
Yeah.
Hey, something you just commented. Are you able? I don't know if it was a private conversation between us or if you're willing to talk about it publicly. And if not, say
Yeah.
can't talk, George. But we talked a little bit about your willingness to which when you all of these deals are curated, right? So you don't
Yeah.
automatically take the data from every deal that's submitted. So, for
Yeah.
example, if there is no earnout, what happens to that data?
So we will take deals. We track earnouts within our data. So we will take that in and count it on it, but we'll reflect that there wasn't an earnout involved in it. And that is one of the questions we ask, which is actually due to the sort of level of complexity and the breadth of what happens in a potential earnout. It's very difficult to compare apples to apples, one
Yeah,
to the
for sure.
other. So it's a binary one on it. It's basically, was there an earnout involved in it? It's actually coupled with seller financing, but the majority of the transactions we look at have an earnout. It's just over half of them that involve an earnout. Now, we don't track it after the sale, but anecdotally, I talked to a lot of deal attorneys. I think the consensus is probably about half of those earnouts ultimately end up in some sort of litigation on it, just because it's a challenging, um, rollover equity. It's pretty concrete. You know
Yep.
what it is. You have a stake in the company. An earnout always has contingencies, and the businesses that are being acquired, they're not going into a static environment, right? So
Yeah,
that
that's right.
company that you know was bought probably made several acquisitions after it was sold, or was an acquisition by a larger company and brought into the fold on it. And I think once you start taking that many variables and put into an earnout situation, there's the very, very least a lot of room for miscommunication. I wouldn't attribute anything to deliberately trying to play games with it, but expectations and what one person hears, one person sees, one person thinks they heard, what they assigned, can often be two different things on it. So I think the earnouts are definitely a big part of the market. Definitely want I think most sellers would like to avoid them if they could,
Yeah,
but
of
it's also
course.
the bridge. It's also
Yeah,
the bridging mechanism, though, between the seller's belief of the value of the company and the buyers, right?
sure.
So in that case, it's a great thing. It's a stepping stone to get buyer and seller to come together, but can be a little bit thorny on it. And again, as part of that longer term partnership you're going to be looking at with the acquirer.
Yeah, absolutely. And you mentioned rollover equity. How
Yeah.
do you guys view that, treat that?
So yeah, we track rollover equity alongside sponsor equity, and we break that out separately in our reports. I'll say on the rollover equity side, it's probably about 65, 68% of transactions recently we tracked that included rollover equity. And again, you're seeing that's across all deals, and we're seeing 40% of the deals we tracked, or just under 40% for the first half of the year, were add-on investments, right? So that's a larger share of the pie for add-ons we're
Sure.
normally seeing. It's generally around 35. It was 32 in 2022, so it's definitely ramped up. So even though it's about 68% of deals that include rollover equity, add-ons traditionally have not included rollover equity, but we're seeing that happening more often there. That rollover equity is right around 17, 18% on average across all transactions. So it's a big number. And I think, again, for the folks you work with, George, the family-owned businesses, the individuals who own businesses, I think that's a huge portion of what you should look at if you're going into a transaction, because there's a tendency, I think, and a whole lot of emotions go through a seller. It's a roller coaster, obviously, in the process. And
Yeah.
particularly when you get into diligence and the final negotiations, you've just gone through an experience where people are telling you your baby is ugly and that, has these warts and
Yeah.
everything, right?
True.
So there's sensitivity there. And then I think that rollover equity portion, which again, very common in most deals and aligns interests, can be something seen as something that, hey, why aren't I getting my money now? I don't want to wait on this. Why am I keeping money in this business? It's just a gut reaction because you're hearing you're going to be getting less money transferred to you than you expected on it. But I really think that way that needs to be viewed is that, that's another opportunity. And that could be that second bite of the apple could be even better than the first. That private equity is going to be on a 3 to 5 year time frame with the with holding the company, but no private equity firm holds a company indefinitely. It's a serial process on it. But they're going to grow that company. They're going to improve it, or that will be their objective during that time. And being able to ride along on it, you could have as good, if not better, outcome from the rollover equity ultimately 3 to 5 years down the road as you did from the initial acquisition of your business. So I
Yep.
think, yeah, a little bit different than what a lot of sellers might expect, but definitely an opportunity and something that I think they should be well versed on going on a transaction. which also leads in, not going on too long, but who you're
Please.
partnering with. Again, it's a partnership. We were talking was doing another podcast the other day, and had an investment banker on with me who works with, small businesses, and he was talking about, you're meeting with buyers. You generally have multiple meetings. It's a half an hour meeting generally, happening, very rapidly, probably at least with 5 or 6 parties, maybe more than that. You're trying to make a snap decision in a very short amount of time about, who's the best person. But he was saying, maybe not more often than not, but quite often it's not the highest bidder that the seller goes with. It's who they feel like they can do business with, who they feel like is listening in the meeting and hearing about the company rather than telling them what they're going to do with it. And that that it's a good match on it. And I think that's what I would stress on. Everyone wants to get top value, but ultimately you're going to be in this relationship for a prolonged period of time, and you want it to be a good one, and you want to feel like you can trust the other party.
It's 100%, and that's great advice for everyone listening out there. You're not looking, you're looking for capital, sure, but you're also looking for a capital partner. You're looking for someone who gets your vision, someone with whom you can work, someone you can trust. And it is not simply about the person who shows up and saying they'll pay the most for the deal, unless you need to get out right now and you're just looking for the most money you can get right now, which will not be the highest value that the business can generate typically.
Definitely. And that is the different, I think that's an interesting point, George, too, because we've had, it's well talked about the transfer of wealth between generations that's happening. It's also well known that we've had a number of events in the last 5 years that have impacted that, in some cases, increasing exit opportunities for those folks. But there's a backlog on it, right? There's people that have wanted to sell their businesses, wanted to retire, do not want to remain with the business going forward, but have not been able to do that or have not focused on it. And I think you need to know that going in also, right? Like, private equity is generally buying a management team along with the business. Not always, but they are. So going into it, I think you need to know, is this something where I need to be there another 3 to 5 years? Is that possible? And if not, what are the other options? And some of those options are on the add-on side. Generally that's not going to be a requirement that management stays on. Oftentimes they do, might be running a division, might run that division, but generally it's not viewed as the essential component of that deal. It's more about scaling the business. But for the platform investments, private equity definitely wants a partnership with management. And then also, if you do want to leave, what does the rest of your C-suite look like? What is that? Have you planned for the transition? If that's the case, that management can move on. You're in good shape on it, but you need to think about that.
That's 100%. That's the first thing that we focus on in our software is, the first question is, do you have an effective senior leadership team, and can the business operate without you? And by and large, our data, and these are business, the medium business is a little over 10 million. Our largest is, last I looked, was 242. So, a nice spread of business, but solidly pre-middle market, middle market. And most of those businesses are failing the effective senior leadership question badly. Well, they're not failing. They simply have not yet built it. And you still have these strong personalities, the founder who is still way too entangled in the operation, which is obviously a huge business risk. Or maybe
but it's all they've known, right? And it's the people that built the businesses, right? You understand that they feel like they can best run it. But as you're saying, I believe fervently, if you haven't future-proofed your business for when you're not able to be the primary, you're not doing your business any favors, right? You need to plan for that transition. We all have huge egos. I mean, we all think we're the most important cog in the machine, but the reality is none of us are. What you need to realize is diagnosing or assessing what you've built, what made it that, and then how do you continue that without your direct involvement on it. And that, just like a sales process, involves a lot of tough, it's introspection, it's a bit psychology. You spend all your life building something. It's your identity, right? To a degree.
Yeah.
You need to kind of step back and then, and take some time and think about it. But really, at some point you need to let your hand off the wheel, let other people manage it. You need the right people in there to do that. That's what you need to focus on. And I think 100%. That's where your management, your skill set, your understanding of the industry transitions to. It's not hands-on day to day. It's hands-on who are the right people? Why are they the right people? What, looking back and saying, what have we done? What is the strength of this? What are the KPIs? Going out and tracking those KPIs, which I know you're big on as well,
Yep,
right?
yep, absolutely.
Um, it's a shift for most owners, but I also think it can be an amazing experience too, because I think most business owners don't take the time to actually go through and look, certain amount of luck, a lot of resolve, a good idea. Things just kind of happen, but I'm willing to bet in every business is more of a story than that. It just hasn't been told or hasn't been thought about. And I think, particularly going into a sale process, thinking about that and getting your head in the right place is essential to getting, a, a good deal done.
Well, and it's interesting because we see that when businesses put in an effective senior leadership team, when they focus on the things that we define as dimension one, right?
Yep.
Maximizing recurring revenues, making sure you have very strong SOPs, that you have a team behind you, that your people are productive, that they're efficient with low turnover. Those fundamental attributes of a business. Funny thing, revenues start to pop. Why does private equity want this to be the case? Because they know that revenues will almost inevitably start growing, which is ultimately the name of the game. This is why we start businesses. And a lot of guys, now I'm editorializing, but a lot of guys forget why they had started a business.
Yeah. I mean, it's a long road, right?
It is.
And I think too, you hear a lot about serial entrepreneurs and they're on their fifth company and everything, and that's wonderful. But the majority of business owners have been one company the whole time. They probably, put everything into it. They probably sacrificed family time. They probably, indebted themselves in the early days. They probably asked for a lot of favors. Like it's a long, long path on it, right?
Yes.
And it's all, and again, 90% of cases, it's all they've ever known on it. So you start to think about transitioning from that, either taking a step back remaining with the company, but getting that next level of management ready, or a sale of the business. That's a huge shock.
Yeah.
And you need to be ready for it.
Okay. So Bob, let's shift gears back into the data. In a or in one of our most recent conversations, you talked about the fact that private equity is going down. Well, I hate to call it down market, but they're busy acquiring smaller, lower gross revenue businesses, smaller businesses, and not necessarily as add-ons. Can you comment on that?
Yeah, I mean, so definitely a lot of add-on activity. I think I actually sidetracked myself when we were talking earlier because of the amount of add-on activity. Traditionally that lower boundary for what we cover was 10 million enterprise value.
Yep.
We're actually launching a product looking at the 1 million to 10 million enterprise value space. Because we're seeing more activity from private equity on it. We're getting deals in that space, but we weren't able to do commentary or any sort of analysis on it because of those sort of limiters on the small end and the large end. But also, there are a lot of business owners at that size, and being able to connect them up with a valuation just makes a lot of sense, to us on it. And the other side of it, as you know, private equity is moving down market a bit. One side, and I think one thing that drove it, and we were talking about, availability of leverage and cost of capital on it, that was definitely an issue for an extended period of time. Smaller deals require less capital. You can go in, you can buy 3 companies at 50 million each, put them together or keep them apart, but you essentially have a 150 million entity, which you're going to be paying a lower valuation on each of those just because of the difference in scope and size on them. Generally, we look at 10 million to 100 million and 100 million to 500 million enterprise value. There's about a 2.5 turn difference on average for the larger companies versus the smaller companies. Those are both big ranges, but I think if you look at it, each size tier that we track, you'd see the same thing on it. Bigger does cost more. It's going to be a higher multiple. So I think private equity is clued in that, at times when debt is expensive and the other thing, because of the credit market conditions, there was a move from larger firms that are generally outside of the middle market to start come down and sort of do the same thing. So it got a little bit more crowded there as well. So it's kind of pushing more activity to the lower end of the market. And then again, these aren't static businesses, right? Most of them that are bought of that size are going to have businesses added to them and will ultimately grow, out above that 50 million size or 25 million enterprise value size just through the acquisitions on it. So I think those are some of the forces driving the trend on it, but there's definitely been a movement toward smaller transactions kind of across the board on it. They're also easier to get done, candidly on it.
Sure.
It's a lot more diligence on a 400 million enterprise value deal than a $50 million deal. They both require a lot, but you're dealing with just a bigger entity, a bigger scope, likely a longer history, more historical information, a bigger data room. So I think, there's the relative ease at the smaller end of the market as well is probably driving a little bit of,
Sure.
and there's more of those companies out there, quite simply, right? It's if you looked at all companies out there, it's on a pyramid, right? And the smaller you get on it, the more that are out there. So the opportunities are better. And I think there's just a lot more to shop through than when you get to the upper end of the middle market.
Yeah, absolutely. And we talk about that all the time. Everybody wants to work with $100 million businesses. There are a heck of a lot more $10 million businesses out there.
It's astounding how many there are, I mean, you look around and I think that's one of the coolest things about, again, on the data geek side, just seeing these businesses and these companies you're looking at, and we don't know what the companies are, right? They're, don't get the name on them, but you start to feel like you know them a bit between the NICS code and the industry and the, revenue growth and the EBITDA and et cetera on it. But it's just the sheer array of entrepreneurs in this country is truly astounding. I think exceptional to the United States and Canada
100%.
to a degree. Yeah.
100%. We have roughly the same population or less population than the EU, and we have a GDP that is significantly more than double the EU. So keep that in mind. People, America haters, beware. We are. I mean,
they get some ammo these days, but
yeah, it's an incredible. We have an incredible. This is an incredible nation, economy, culture. Nothing's perfect. Anyway, I'll leave that topic alone. Hey, let's talk a little bit, Bob, about terms. What are you guys doing with deal terms?
Yes, we do a deal terms report twice a year on it. Always an interesting one. And we actually, with the website relaunch, all of our data points are up there. So you can get it updated when we update the quarterly information. It's interesting. I'd say the biggest thing we talk about is whether or not deals are involving rep and warranty insurance. And, the story on that, 2021, you had this deluge of deals. It was the highest volume that we've tracked for deals on it, over 500 tracked that year by GF Data. I think everyone who's in the middle market would agree that once people figured out that deals could get done during COVID, everyone went out and did a lot of deals. And and it was just a boom period for the market. The thing that came out about that is you had demand for rep and warranty insurance that was unprecedented. So you had a lot of underwriters going out there, a lot of groups launched, a lot of new groups within existing insurers launching those groups. And it kind of became standard for the 100 million to enterprise value and up on it. And then the deal flow started to slow down a bit, and you had all these insurance underwriters out there that didn't have that many $100 million deals. So you started seeing it move down market a bit on it. And I think one of the things we tracked on that is that rep and warranty insurance, while not used on every deal, the use of it has definitely increased over the last 5 years, in part just because supply and demand, and there was more demand from the providers of the product than there was in the marketplace because there was fewer deals going on. But I also think that it's a sign of the deal market getting more sophisticated, which we're seeing on every level, right? Like, why take in a problem? Why have to deal with an escrow? Why have to have that situation when you have a ready-made insurance product that is specifically designed to do this deal? I mean, different but equivalent. Why not have AI in your deal room so that you don't have to look at 9,000 documents and have paralegals look at it when it can all be gathered together? And I think most of the deal rooms that are out there, the well-known ones, all have that capability at this point. But I think it's this whole area of trying to work smartly, and where an existing solution is there, take advantage of it.
Well, and
Go ahead.
Yeah, absolutely. I mean, to the extent that the acquirer can make risk go away, and that the seller can also paper their butt, pardon the term, and make some of their personal risk go away. It's insurance is a cool tool.
And then related to that too, we have seen indemnification caps moving quite a bit. Again, over about the last 6 quarters on it. And you're seeing that, based upon perceived risk in the marketplace. And we've already talked about, it's been a roller coaster since COVID, the conclusion of COVID. You had financials where you're looking at with, 2 to 1 year that were clearly impacted by COVID, either positively or negatively, but you didn't really have level ground on that for a period of time. We were just kind of getting to that point with 2025. You had, the Fed rate going from effectively zero up to, above 5%. And, all the leverage loan market is based upon what's now SOFR. It used to be LIBOR, right? They got rid of LIBOR because all the London bankers were rigging it, but that takes us off topic here. But so SOFR, the SOFR rate, Fed rate is what all these loans are based on. So as that ratchets up, that puts pressure on existing portfolio companies because their costs are going up on it based on the SOFR going up. But then, the other thing that impacted it, I think, was you had Silicon Valley Bank go under, which was March of 2023, I think. I'm going to get the year wrong, but I believe it was that. And we forget quickly, but it was the second largest banking failure in history. And it was also very much, I say linked, but it was a homogenous type of user for that bank, right? It was venture firms and venture-backed portfolio companies using it for their payroll services, basically all their banking services on it. And, candidly, it's been written about. That's probably one of the reasons that it did actually go under, because you had this sort of ecosystem where everyone was in touch and everyone was aware there was potentially problems there and everyone was going to go and get their money so they weren't in trouble on it. But I think the fact that it was linked to a particular investment domain and that it was such a large crisis on it, that basically took banks out of the lending market. And effectively, they didn't necessarily back out of the market. They just put their rates way, way, way above SOFR. And that's right. And, it makes sense, right? They have capital requirements. If they exceed those capital requirements, they got to go look at layoffs or other ways to reduce costs on it. But I guess all this to say, you had several perfect storms in a row for a period of time that had an impact, and those storms were kind of rattling around with indemnification caps on how much risk is actually on this transaction. Whereas in a normal environment, it's more about the company itself or potentially the industry on it. Generally, not concerns about the entire market or entire parts of the market. But that's sure. That's what the last few years have been.
Yeah, and it has been a roller coaster. It's for advisors, it's an interesting time. Instead of one crystal ball, you need like 5.
Yeah, right.
Hey, let's jump to something I think we also discussed recently was sell side Q of V. What do you seeing there?
Yeah, so this is an interesting one. We talked about last time with the reboot of the website. We actually added in 3 additional fields that we're collecting on. So we have 33 fields we ask our response to fill out, and the 3 new ones are we did a broad regional, so for the United States, kind of southeast, central, northeast, etc. We've always had a significant number of Canadian firms contributing, but we never had a way to break that out. So we now have a way to allocate Canada separately. We're also looking to expand outside of the US and Canada in terms of what we track. But then the second one was date of letter of intent, which was very much of the moment as well, because diligence processes are stretching out longer. There was a tendency, again, just trying to figure out what flat earth looks like coming out of COVID in terms of what a P&L looks like. A tendency to kick deals an extra quarter down the road because the acquirer wanted to see another quarters of financials to see if it's actually tracking the direction that it appears to be tracking. But we wanted to get a gauge on what actually has happened in terms of the time from the letter of intent to the close of the deal. So we started asking about that. And then the last one was there a sell side quality of earnings done on it, which I think at the time we started asking, and this was 4 quarters ago, I think it was somewhat prevalent, but not all that prevalent. I think it's actually ramped up in the intervening time. But what we did find with it was a 3-quarter sample size at that point, is that you get about half a turn improvement in valuation for companies that do a sell side quality of earnings versus ones that don't. And I think, I say that to you, Jordan. I think when you talked about it originally, it was kind of like, well, that makes sense, right? Like, I don't know if it's necessarily the sell side Q of E specifically that does it, though I do think what a quality of earnings unearths is incredibly important for a seller going in before
Yes,
the buyer
100%.
conducts theirs. But even more so, I think it's a reflection that this is a seller that is engaged and buttoned up on the M&A process, with the sell side Q of E just being one arrow in the quiver of multiple that they put together before actually going out and having those meetings with potential acquirers. Um, and probably an indication too, ideally on most cases, they have a investment bank representing them, but they're being well advised on it, and that they're taking the process seriously, and that they have, you know, the right tools in place to be able to do these sort of diagnostics on their business. Because the other thing, as we know, every skeleton in the closet, I guarantee you, will come out and do it in diligence. So you may as well know every one of them going in. So at least you have an answer of how you're addressing it. And you don't say, no, that's not the case, or you sit there slack job when this list of problems comes out. I mean, it's just the reality of it. These are people
Yes.
doing it every day. It's the equivalent of, you know, how do the police know if you're lying? Well, they've talked to 25 different suspects today, and that's what they do every day.
Yep.
Private equity looks at companies, they buy companies, and they kick the tires on companies, and they diligence companies. They're Nothing is going to get past them. If you think it's a concern, they will find it.
100%. Man, I could talk about that for the rest of the day, because due diligence, the truth, Shakespeare said it, the truth will out. There is
Yep,
no, you're not going to, the truth will out.
definitely.
And, and doing a sell side Q of E, I mean, it seems to me, if you are not, to your point, you're knowledgeable enough and you do the sell side Q of E, you're going to identify the problems yourself
Yep,
and have an opportunity to fix them, not in the middle of a negotiation. It doesn't
yep.
surprise me that you're getting an average half turn. That's which is typically a lot of money, right?
It's
We're not.
it's it's a lot of money, yeah. And even if you take it out of the context of a sales process, I think this is information you can use to improve your business, whether or not you're looking at a change of control on it, right? And I
Yes.
think, again, I don't think it's ever conscious, but like, quarter comes into the next quarter and you're running the business, but like, again, that being able to take a 30,000 foot view and look down on it and try and do it objectively, and have the diagnostic tools like a sell side QOV to actually look at it and say, all right, is our revenue lumpy? Do we have customer concentration issues? Is there risk involved in the revenue? Finding that out, again, whether or not you're going to transact is incredibly valuable and can really help you, either in conjunction with a buyer or independently improve the value of what you have.
Yeah, and it's funny. There's a shameless plug for ourselves.
Yep.
We purposefully and by design identify potential sell side or potential Q of E issues in
Yep.
the Clarity software. We don't call it that, but
Yep.
all of the factors you just mentioned, in fact, all of the factors I think we've discussed from an operational perspective will be surfaced by the Clarity software, which is
And that's one of the things I love about what you're doing, George, is that putting the additional shameless plug here, but I mean, again, it's arming the seller with insight about their business, whether or not they end up pursuing a sale, right? And I think that's the other thing. We look at this and it's like, and you deal with a lot of M&A professionals. Deals are the end goal, right?
Mhm.
Like that's what they want. That's how they get paid. It's how the ecosystem works. But that doesn't mean it's the best path for every individual or family that owns a business out there, right? You can look at it, but I
100%.
do think considering it and doing it right will give you tools that will help your business, whether or not it goes to a change of control. It might impact you and say, you know what, I want to stay with it, but I need additional capital on this. So you look at growth financing. It might say, you know what, if we make a few changes, you know, we could actually get more debt on board, but at a reasonable level on it. And we have a strategic plan for where that goes and grow the business on our own, right? There's a reason why private equity is talking to you and wants to buy your business. They clearly think they can make it worth more than what it is with you owning it right now. That, the steps you take going into at least investigating a sale could help you potentially do that on your own.
Yep.
So again, I think the questions you ask are, you know, always going to come up at times when people are in this sort of process, but they have value at any time within a business.
Yeah, 100%, 100%. And I make the argument that there's a seventh exit option. So you and I have been talking here about sale to a third party,
Yep.
but the best of the best businesses allow the owner to exit the accountabilities chart, right? And move into being a true CEO without digressing on that, and eventually maybe becoming the chairman,
Yep.
and not giving up ownership of the business. And maybe you're working a lot less in the business, and working a lot more on strategy, or simply taking your annuity and letting others run the business for you. That is that is like doing an internal private equity deal, where
Exactly.
you're creating your own annuity stream. And that is, I think that is the ultimate, the best of the best businesses do that, which automatically, if you've created an oil well, you essentially automatically have a business that could be sold relatively painlessly, always relatively.
Yep.
There's going to be pain, but
Always.
and typically at a high multiple. Those businesses with that high strategic capacity are really just killer, and they're fun to run, man. That's what a lot
And
of business owners don't get. Yeah.
Well, and I think that's you get into, you get to that level where you're at the board and you're actually thinking strategically. It's also a chance to step back. And I mean, we all wear many hats, right?
Yep.
And those hats are often dictated by what hat is required right now at this particular stage. That doesn't mean that the hat you're wearing most of the time is the one that's most comfortable for you or what you want to do, right? So you step out of it, you can figure out, well, I've been hands-on with this, but maybe you haven't had a chance to really look at the strategic side of it. Maybe you could do the same thing you did with this business with another business. Maybe your business should be merged with another business. Maybe, but like, those are potential opportunities. It's very difficult to look at fairly while you're knee deep in other problems and other challenges going on. Right? So that distance, again, I think we're talking about, can be very, very useful for an entrepreneur.
Yeah, absolutely. Hey, man, we've been talking for, hard to believe, for a little over 40 minutes.
Oh, wow. I didn't even look at that.
Let me just ask.
I haven't talked too much.
I love these conversations, which is why I suggested, hey, man, we should do this on tape.
Yeah.
There's an anachronism. Well, we'll just go with it on tape. Hey, maybe in closing, we could talk about, what do you see? What are you guys tracking? Anything with integration, successful integration, problems with integration?
Yeah. So unfortunately, the deal closes and we're kind of done with it, which is the traditional model in the business. I think, though, that's a great area to look at. And that's an area that I would consider having GF Data start to look at on it. We've always just modeled it, though, that we're a point in time. And it's at that point that deal closes. We are looking at, again, because the data is very specific on it, and there's so much that happens at the other end. We're looking at potentially some products that would look at what does a broader market look like, how many opportunities are out there in a given space, where do they actually go? So, kind of how many go to private equity, how many go to strategic, how many don't go, basically the outcomes of the opportunities out there, market share for investment banks, that sort of thing. Again, nothing firm on that, and then the other side of it is, well, where do these companies ultimately go, right? Because that initial close of the deal is actually the beginning of the private equity cycle of that business. Being able to look at them from inception to ultimate exit on it, and that path on it is very compelling also. But as of now, it's just a single kind of point in time, but we definitely want to expand in both directions from it.
You're giving me an idea for a product of our own.
There you go. Well, maybe we can collaborate on a product.
Yep, I like it. I like it a lot. That would be super fun.
Yeah.
Okay, Bob. What have I not asked you? Anything that I haven't asked you that you think is super interesting?
I think it's been a great conversation, as it always with you, George. And I thought the call to do it as a webinar made a lot of sense, and really enjoyed this so far. I would say for your listeners on it, for some of the stuff that we did mention in here, I believe it's the fall issue of Middle Market Growth is going to be coming out, I think, in October digitally. It's at middlemarketgrowth.org. That's the magazine for the Association of Corporate Growth. But we've got 2 articles we're doing for that. One looking at the results from the 1 to 10 million enterprise value side that I mentioned we're expanding into. So that'll be kind of the inaugural cut on that. You'll get some good data on it. And this is all free to access for everyone. That's why I'm mentioning it. And then we're doing also another piece looking at those 3 new data points on it. So a good chance if people are interested, want to take a look and find out more what we do. I always enjoy doing those pieces because, a lot of what we're doing for the GF data reports is it's data, right? It's I get to let my hair down a little bit and indulge the journalist side of me that is latent of late with the magazine articles, but they're fun to write and you'll get an idea of what we do. So definitely take a look for those. And
What's
then,
the URL again, Bob?
so the URL for Middle Market Growth is middlemarketgrowth dot. Let me just confirm it. Sorry.
I
think it's done.
Find it. I'm just going to post it in our community.
Yeah, it's middlemarketgrowth.org.
Awesome.
And then ACG is acg.org. You can find us at gfdata.com. A lot of information there.
Yes.
And I guess the last thing I'd say is we're on the second build that'll be coming out at the end of this month for our online database, and added some really nice features there, great customization options, and some really nice data visualization options as well. So if you wanted to take a look at the product, next couple of weeks is a great time to do it. And I think really enjoyed the conversation. Thanks for me on.
Same.
And I don't think there's too much else to add on it, but and again, I love being on here because you're a great customer, and I love what you're doing. And I think again, it's a benefit to people looking to potentially sell their business.
Okay, thanks, Bob. Man, I agree. Always enjoy our conversations, and I'll look forward to seeing you at some point in person here over the course of the fall. And good luck.
I guarantee you at some point.
Yeah, exactly.
Doing a lot of traveling.
And good luck with getting your oldest settled in college.
Thank you very much. And, I can't believe we've made it. Yep.
Yeah. All right, man. Thanks, Bob.
Right.
I'm going to.
Thanks, George.
This episode is brought to you by the Growth Drive Summit. Our theme this year is building a profitable advisory business. Join us in Charleston, South Carolina, October 6th, 7th, and 8th. Expand your network, learn new skills, and generally have a good time. This is a top-rated event. We're looking forward to seeing you there. Thank you.